If you sell a property this year and generate a $300,000 gain, you could owe more than $50,000 in federal taxes alone. And most investors think they only have two options: pay the tax or lock themselves into a 1031 exchange with strict deadlines and zero flexibility. But that's not entirely true. There may be a third option, one that removes artificial timelines, keeps you in control of your proceeds, and still creates meaningful tax efficiency when structured properly. In this video, I'm going to walk you through the three primary ways to handle real estate sales, when each one makes sense, and how to decide which fits your situation. Quick disclaimer first, this is educational only. It's not legal, financial, or tax advice. I'm not a CPA or a tax attorney. Always coordinate with your advisor before implementing any strategy. Now let's break down what actually happens when you sell. When you sell a property, you're standing at a fork in the road, and the decision you make affects liquidity, control, risk, and long-term compounding. Historically, investors thought the decision was binary: pay the tax bill or complete a 1031 exchange. But that framing is incomplete. Let's start with what actually happens when you sell. When you sell an investment property, the gain is usually split into two categories: capital appreciation or capital gains, and depreciation recapture. Now, depending on your income level and your state of residence, you may also be subject to NIIT and state tax. So let's dive into it further with a simple example. Let's say you sell a property and you realize a $300,000 profit or a $300,000 gain. In this example, let's say $240,000 of that is considered capital gain and $60,000 is depreciation recapture. At current federal rates, you could owe over $50,000 before state taxes are even considered. And that's real money. And that's when the fork in the road appears. With option one, you can pay the tax. It's simple. You sell, you recognize the gain, you write the check, and for some investors, this is absolutely the right move. Now, when does paying the tax make sense? It can make sense when the gain is small. You want liquidity, you're simplifying your life, you're rebalancing away from real estate, you don't trust the replacement opportunity or the operator, or you have a suspended passive losses that offset the gain. Now, paying taxes is not failure. You shouldn't look at it that way. Paying taxes is actually the cost of success. Sometimes liquidity and control are more valuable than deferral. But now let's take a look at option number two. That's the traditional 1031 exchange. This allows you to defer taxes by rolling proceeds into another like-kind property, but it comes with strict rules. The qualified intermediary must hold the funds. You have 45 days to identify a replacement property, 180 days to close them. You must meet equal or greater value requirements, and any boot or money you want to take off the table is taxable. Now, when could a 1031 exchange make sense? It can make sense when you're facing a large tax burden. You want to remain fully allocated to real estate. You don't need liquidity. You trust the operator, and the replacement asset is financially compelling. Don't get me wrong, a 1031 can be very powerful, but deadlines create pressure, and pressure can distort underwriting discipline. It can also force you into mediocre or less than desirable replacement properties. The tax tail should never wag the investment dog. That's an important principle that you have to keep in mind. But here's where it gets interesting, because a 1031 exchange is not the only way to create tax efficiency when you sell. There is a third option, one that removes artificial timelines, one that keeps you in control of your proceeds, and one that has been vetted by multiple CPAs and implemented successfully by sophisticated investors. I call this strategy calendar year tax synchronization. Some people refer to it as a lazy 1031 exchange. I prefer to think of it as intentional tax code alignment. Here's how it works. You sell a property and recognize a gain. You reinvest in another real estate asset within the same tax year. A cost segregation study is utilized to maximize front-loaded year one bonus depreciation. And keep in mind that as of July 4th, 2025, 100% bonus depreciation has been made permanent. That means qualifying assets can generate substantial first-year depreciation. If structured properly, and if those losses are usable within your specific tax profile, they can offset part or potentially all of the gain from the sale. There's no qualified intermediary, no 45-day identification rule, no 180-day closing deadline, no equal or greater value requirements, and partial reinvestment is possible. But this is not automatic. Passive activity rules apply, and this requires coordination with your CPA before the sale occurs. Be proactive if this is something you're interested in using. Talk to your CPA frequently throughout this whole entire process. Now, why would somebody choose this? Investors consider this strategy when they want tax efficiency without deadline pressure. They want control of their proceeds. They want to diversify into multiple investments. They want partial liquidity. They're transitioning from active to passive ownership or vice versa. They want to move away from a syndicator they no longer wish to partner with, or a traditional 1031 could fall apart and they need a same year alternative, a backup plan basically. This strategy creates flexibility. But keep in mind, flexibility without discipline can be dangerous. The underwriting still has to work. The fundamentals still have to be there. Here is a side-by-side comparison. Each of these models, each of these exit plans have pluses and minuses, things to consider. And then lastly, always remember that the right answer is personal. The real question is not, do I pay taxes? The real question is, what am I optimizing for? Do I need liquidity, control, continuity, risk reduction, operator alignment? Tax deferral is just a tool. It's not the strategy. It's always important to remember that. For years, investors believed the choice was binary. Pay the tax or execute a 1031 exchange. Today, there may be a third path. None of these strategies are inherently superior. Each simply solves a different constraint. The key is making the decision intentionally, not reactively, and not under artificial pressure. If you're facing a sale this year and want to help thinking through your options, reach out. We'll model the scenarios, coordinate with your CPA, and make sure the strategy fits your goals, not just the tax code. Capital compounds best when decisions are aligned with your life, your risk tolerance, and your long-term plan. That's how wealth builds responsibly.